Okay, thank you, Carlo. Okay, so just before we do some Q&As, let me just rattle through some graphs to back up some of the claims that Carlo was making there. So, I mean, one of the things about the current situation we're in is that there's a supposed deficit in the scheme. Why? Well, it's not because people have suddenly decided to live longer over the last 3 years or anything like that. It's to do with forecasting investment growth in the scheme. You've got 60 billion today. You want to know how far that's going to go over the next 30 years. How much money can you pay out of that? That depends on how fast your investments grow. Right, let me just show you what's been happening over recent years. This was the asset growth in the fund all the way up to 2011. You've got some features here. This was the dot-com bubble bursting in 2001. This is the crash of 2008, which then recovered. Anyway, in 2011, I'll move this down to the bottom corner, there was a valuation of USS. Now, this was the valuation in which it was deemed final salary couldn't continue, so new entrants were put onto a career average defined benefit scheme. Anyway, what USS had to do at this point was to forecast where this line was going to go. I played this game with my 6-year-old the other day. She did quite well. So where does that line go? Well, USS said it'll probably go like that, which looks fairly plausible looking at the graphs there, and that meant that final salary was unaffordable for the future. Okay. Where did the line actually go? It did this. So in fact, that's not a terrible estimate there. They did quite well in 2011, and they said that that meant final salary couldn't continue. Okay, moving on, shifting that down, they did the same again in 2014. Now this was the last valuation at which it was decided that nobody could continue on final salary, even the people who were already on it, and at this point we need to go to a career average scheme for everybody, and with a cap at £55,000, you'll probably remember. Anyway, let's look at how this graph goes. So that forecast from 2011 carries on like that. Then they have to forecast what they think is going to happen this time. Now bear in mind, they outperformed just slightly. They outperformed their forecast from the previous time. This is what they came up with. I think my little girl thought it was going to go a bit higher than that, the solid line. But anyway, that was their forecast. And if you just look at this timescale, it looks like you're kind of reverting back to their original forecast, which could just about be defendable. Anyway, let's see what actually happened. That's what happened to the investment growth between 2014 and today. So vastly exceeded the forecasts. Right, okay, so let's shift that down and see where we are now. So now I'm going to forecast off to 2037 here. And let's extend those two forecasts from 2011 and 2014 onwards. And you'll see, in fact, that the 2014 valuation, while it looked like it was roughly sort of heading for the same line as 2011, in fact, it crossed over and ended up underneath it. This is precisely why in 2014 we were told what we currently had wasn't affordable, because in the long term we're expecting to have less money as a result. So this forecast in 2014 was lower than in 2011. Okay, so then I play the game with my little girl again. What's the solid line going to do? Now, you might think, and there are some people saying that this looks a bit like a bubble about to burst in the same way as this one burst and this one burst, which is possibly fair, but notice that the bursting of a bubble usually follows with a recovery. So even if this bubble burst, you'd probably expect it to keep on going up there. Right, this is what the forecast looks like now. So that is the forecast that says the only option is defined contribution. Okay. Although, actually, that forecast, as drawn, that says the current scheme is just affordable. We had a representative from USS visit the working group that we got in Sheffield, where we meet with, as me and Matthew serve on this group, we meet with senior human resources directors and finance directors to talk about the pension situation. And a representative from USS said, actually, according to that forecast, the deficit is minimal, something like £500 million, and the current contribution rates are okay to carry on with the scheme as it is. So why have we got a deficit? Well, in September, a valuation was produced where it was decided that not only was that the forecast for how the current investments would grow, but the fund would plan to de-risk its investments, a bit like Carlo was saying, shift them away from growth-seeking assets towards safe assets. What does that do to that curve? It moves it down a bit. So that was what happened in September. Once you move it down like that, you get a £5 billion deficit occurring. Okay. But that's not enough, because in September and early October, there was a consultation with universities asking what their thoughts were on this, and they said, well, yeah, that looks about okay, but we'd like a bit more de-risking because we want to move as much risk as possible off our balance sheets. So they pushed for the curve to go down even lower, okay, because they wanted more of their assets being moved into safe return investments. Okay, now let's zoom in on that last little bit of the curve. So here's three. The top one is the unde-risked forecasts. Then you get the ones that were in September, and then the ones in November. So those are the three sort of profiles that we've had that we can discuss with regards to how things are going from here. Stick some numbers on it. In 2037, if we don't do any de-risking, we expect to have something like 117.7 billion in assets. If we de-risk according to September, we end up with 112.3. If we do the more severe de-risking that's now on the table, we end up at 106.7. So, what does that mean? It means over the next 20 years, there is a cost to the sector of de-risking of around 11 billion, according to these November plans. Now, that's not a nominal cost. Some of these things are kind of nominal, sort of projected things. That is an actual expected cost to the sector. £11 billion. That's money that's going to have to be found from somewhere, either in providing lower pensions for us, or in restraining pay further, or in not building new diamonds. So in fact, if you want to know how much it's costing the University of Sheffield, I'm going to check the figures with our finance people when we meet in the working group. I think we're responsible for about a 50th of the total. So I think it's costing the University of Sheffield 220 million over the next 20 years, taking this investment path. Now, the other thing to say about that is adjusting the future benefits doesn't get the university off the hook for this. This is money that has to be found to pay the past accrual if you de-risk. Okay, so there's not even by going into DC you're going to get away from this. This is money that I think the university is finding itself stumping up over the next 20 years, which is quite something. Okay, I'm nearly done. Let's just go back a little bit. This is the sort of the final thing I want to say. 2008 there was a valuation. They happen every 3 years. Now this was just before the crash, of course. And at that point, this is what... so this was the last time it was deemed affordable to have a final salary scheme without any changes. And that was the forecast they had. Of course, we know what happens next. There's a crash and a dip. Okay? And because of that crash and a dip, nothing was affordable anymore. Interesting thing is, if you draw on what actually happened to the assets from 2008 to the present day, you get that. Now, you may notice a feature of that graph is that we've ended up back on the trend at which we were expected to be in 2008. Okay, that was when they said final salary pensions were affordable. Since then, we've had 2 downgrades and we're due a 3rd. So there is some very dubious stuff going on here intellectually, but we have been challenging the intellectual arguments for the last 3 years. We're not getting very far. It's a bit like banging your head on a brick wall with this. So, I think that's all I wanted to say. So we've got a Q&A now. Do you want to say something before we start?
Very briefly.
Okay, a quick word from Matthew and then we'll do some Q&A.
So you've heard lots of numbers, seen lots of really good figures that Sam's put together. I think if I was going to boil it down to a TLDR version, it would just be this. The scheme right now is estimated to have, best estimate is an £8 billion surplus. Carlo mentioned that earlier. So 50% likely to be better than that, 50% likely to be worse, best estimate. Okay, that's not acceptable. You add in prudence, and it's about at this break-even level that Sam was talking about, within $500 million or so. Then you sell off your well-performing assets in terms of de-risking, and then suddenly you've created what the press is selling to us as a deficit, as a shortfall. That's just not there. And on the basis of that, we're being asked to have, well, retirement redefined. And that's really what has us concerned, and thankfully has enough of you concerned to be here as well.